On Wednesday, May 21st, the US stock market experienced a Pinocchio day. The character Pinocchio, you may recall, tells us he is lying by the fact that his nose gets longer each time. The Pinocchio bar gives us a false impression of the true trend of the market. The two ingredients for a bearish Pinocchio bar are an intraday price rally that takes it through a key resistance level. That's the nose. And the second requires the open and the close to remain below the resistance. Resistance can take the form of an actual number, a moving average, a measured move from a price pattern, or in the latest action, a trend line. Here's a chart of the S&P ETF, the SPY. And here's the trend line in question. See how each of these small rallies was turned back by the line. Now that's resistance for you. Now, if I uncover the Pinocchio, you can see that both the intraday action pushed through the line, but the opening and closing prices failed to move through the resistance. In effect, anyone who bought on the basis of the breakout and went home long has a loss on their hands. Those buyers now represent future pressure on the market, especially as Wednesday's volume in the ETF, as you can now see, was pretty heavy. Some may classify Wednesday's price action as an outside bar, that is, one that encompasses the previous day's trading action, and that's also an accurate label, and it's also bearish. The question is, how bearish? These types of patterns typically have an effect for approximately 5 to 10 days, and that's really all we should expect. However, they sometimes develop at a time when the longer-term indicators are finally balanced and set to tip over. This net new high indicator for global equities looks as though it might be diverging negatively with the MSCI World Stock ETF, the ACWI. In the past, when it's done this, and the price is confirmed with a trendline violation, a decline of some kind is followed. Wednesday's action caused it to tentatively peak again, and that could mean under the Pinocchio 5 to 10 day rule that further downside pressure will be placed on the market over the next few sessions. And that most likely means that the indicator will diverge negatively with the price. So all you would need to see is some confirmation, and that would come with the violation of this all-important trend line and the 200-day moving average, both of which are around $49. This is also May, when the old adage, sell in May and go away, has often worked quite well, especially when least expected. This chart shows the results for a Google search for articles on sell in May. Each of the peaks developed in May of that specific year. Note that 2013 currently holds the record. From a contrary point of view, that should mean that it's not going to work this year because the selling has already been anticipated. However, a review of the first few pages of the actual search returns show that the headlines of the vast majority of these articles are sympathetic to the view that sell in May will not work this year. That means that the contrary view is that it will work. It seems to me that it's very unlikely that all those writers are going to be correct. If you enjoyed this chart of the month, you may want to go to Pring.com and download a free sample of our intermarket review. A monthly roundup of the world's principal financial markets with a special emphasis on the US. We also look at global indicators, bonds, precious metals, currencies, and international markets using ETFs to execute our strategies as much as possible. You'll find unique indicators and intermarket relationships you cannot find anywhere else. In the meantime, thanks for watching and good luck and good charting.